Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Henry Stimler. Henry is an executive managing director of global commercial real estate at the firm Newmark, whose team financed $4.4 billion in deals in 2022 alone. Henry's core focus is origination and brokerage in large multifamily debt and equity transactions. And in just a minute, we're going to speak with Henry about the impact of the current economic factors on the commercial real estate industry, and we'll drill down into multifamily housing. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Henry Stimler. Welcome to CRE PN Radio.
Thank you very much for having me.
Well, Henry, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I'm British born, lived in the UK, moved to New York at the age of 22 in 2002. Did a few things in the time there. In 2017, I joined Cantor Fitzgerald, which was the controlling shareholder of Newmark. In 2019, myself and my team got transferred from Cantor to Newmark. Fast forward to today, we are one of the number one lending groups in the company, and I would say in the country. Our core focus is obviously multifamily, where we originate billions of dollars of deals and loans. But we also do office, industrial, hotel. So we touch all the sectors, but our core focus is multi.
Got it. So let's talk just a little bit about the current state of the commercial real estate market. When you're doing the origination, who's your typical client? Are you working with individual investors, syndications, or how? What's the and then what's kind of a sweet spot for you as far as the size of the loan that you work on?
So I typically am looking to do larger size deals. The deals all take the same time, from a $10 million deal to a $100 million deal. So if I can focus on the bigger deals, that's a better use of my time. I cover institutions. We cover some of the largest institutions that own 30, 40, 50,000 apartments. Some of the largest developers. We closed a loan a few months back for Larry Silverstein. He built the World Trade Center. It was a $176 million construction loan for a new development in Queens. And then we also have the syndicators, we have the smaller mom and pop investors. I'm always a very big believer that from small acorns come big trees. So one of my favorite things to do is to help my clients build their businesses and achieve their dreams. And we've helped guys go from 1,000 units to 10,000 units and up and up and up. So that's what we love to do. But so we have the entire gauntlet of different types of real estate investors, from the big institutions, the syndicators, the mom and pops, and then the guys just starting to get on their feet and start to expand their portfolios.
Got it. And are you geographically limited to New York, or where?
No. Okay. I do deals all across the US. The last deal I closed was in Dallas. It was a new built multifamily deal bought by a group called Harbor Group. I closed a deal in Columbus, Ohio. Another multifamily deal. We are closing an office deal in Dallas again, taking out a construction loan that we did in 2017 in Boca Raton of a hotel condo, an apartment building with a golf course for $460 million. So I'll go where the business is.
Got it. I've heard you mention construction quite a bit. What percentage of your business is new construction versus an existing um, property?
So I would say that those numbers have changed dramatically in this year, obviously with the rise in interest rates. A lot of construction deals that were shovel ready, developers are taking a pause because their cost of capital has risen so incredibly. So I would say right now, less construction, more buying and holding, or buying and fixing.
Got it. Got it. And on the buy side of the existing stock, is there a or what are the typical length of the or the term of the loans? Are they 10-year holds, 5? What's the
So it always varies, always changes. Last year, when interest rates were historically low, a lot of people were taking out floating rate, shorter term loans, predominantly bridge loans. The bridge lenders were very aggressive in the space, lending 75, 80, all the way up to 85% LTV. Those were 3+1+1, 3-year term plus 2 extensions. But now with the incredible volatility in interest rates, we advise our clients to lock in fixed rate money, because the indices and the treasury just keep on moving against us. So rather than be exposed to continued hikes, to continued fluctuation, lock in 5-year money, 7-year money, 10-year money. But it also really depends on what your business plan is. So if you're buying a transient asset, if you're buying a building that's a 1970s building, it's in need of a lot of love and TLC and care, but it's in a fantastic market, in a fantastic neighborhood. You know your comps of other buildings that are in better shape are getting higher rents. Those type of deals, you want to go in, you want to fix it up, push your NOI, and then be able to do a refi, so pull your money out. So if it's something that's super transient, you don't want to lock up long-term money, because it's going to be very difficult then for you to pull your equity dollars out. But if you know that if you do the work, you're going to get a big pop in rents, I would advise then to take a floating rate loan, do the work, fix up the property. Once you fix up the property, once you've pushed NOI through the roof, come back, lock in a fixed rate deal, and pull out some of your equity.
Got it. And as far as the different loan products, you talked a little bit about bridge loan, and then kind of referenced the different length of terms. Is it agency, or is it?
Yeah. So today I would say that the biggest players are in the space, a little bit to my chagrin, because it gives them a lot of power, is Freddie Mac and Fannie Mae, right? So they're really not competing with anybody else, because the regional banks have pulled back tremendously. The debt fund lenders have pulled back tremendously. So for multi, besides, I would say on much bigger deals, when you can access Blackstone's money, KKR's life insurance money, Ares's money, these big conglomerates, the really only game in town you have is Freddie Mac and Fannie Mae. But that's amazing, and that's what makes multifamily such a unique asset class, is that you have these government-backed programs that have $170 billion to put out in 2023.
Right. No, it is. It's almost scary when you see just how the cast of players has changed so much, and just the rates have changed so much. What are you seeing from the? I guess let's talk about the seller side of the equation. As far as somebody's got an existing property, they're looking to exit. What are you seeing as far as their expectations versus the reality of the market?
So of course, sellers are always want to get top dollar. They always want to sell at the highest price they can, and for many years they've been able to get. It's been a seller's market. The seller says, "This is what I want. I want a 3.5 cap," and they've been able to achieve those staggering cap rates. Today, it's not so much a seller's market; it's more a buyer's market. But there is a disconnect between buyers and sellers, right? Sellers still want to sell things in the mid 4 caps. Buyers don't want to take negative leverage. They want deals that are 5.5 caps. So there's that disconnect time. That's why we've seen transactions fall off a cliff. I think there's a 75% drop in transactions from 2022 to 2023.
And as far as the gap there, are you seeing more sellers
Capitulation?
Well, as far as the sellers that are selling, I guess the deals that are getting done, are those sellers that have to sell, or are they at the end of their financing, or what are you seeing there?
So you've got two types of sellers that have to sell. You've got guys that, especially on new development, construction, merchant builders build the product. Typically, they've got a little bit of runway to lease the deal up and then put it on the market. And the banks will allow them that time. Now, the construction lenders are just scrambling to bring as much money back in. So the pressure on the merchant builders is immense. So they are under tremendous strain, and especially because they took out floating rate construction loans when SOFR was, let's say, 10. Today, SOFR is close to 5. So their cost is so much high, it's astronomically high. So the pressure is on them. They're choking. Again, lease up deals don't bring in a lot of income because you're leasing up the properties. So merchant builders are really feeling the squeeze. Then on top of that, you've got guys that, again, took out floating rate debt, floating rate variable option debt, especially bridge debt that needs interest rate caps. Those interest rate caps have gone through the roof, that insurance against interest rate costs because of the volatility within the lending market. So guys that have loans that are coming due, they're also under tremendous pressure to go and sell. But a lot of these guys are going to struggle because they bought deals at the height of the market when cap rates were in the 3s. Today, the market is in the 5s. So a lot of them are going to have to sell for a loss and swallow it and just do what they need to do. And they don't really have a choice.
Yeah. No, and as far as that goes, do you see, or is there a lot of debt that's due to reach the end of its
Yeah.
term this
Yes.
year, or what's the?
Yeah, a tremendous amount of debt put on 3 years ago, and again, they would say, well, we have another 2 plus, we have 2 1-year extensions, but to get those extensions, you have to meet certain DSCR requirements, and a lot of those deals are not going to meet those DSCR requirements, and they're not going to get those extensions. So guys that took out 5-year paper with a 3-year plus the 1+1, when that 3-year term comes to an end, they're going to either have to refi out of that existing loan into an agency loan, and the agency loans many times not going to size to where the bridge loan was, or they're going to have to sell.
Yeah.
But
No,
I do want to just caveat and say that the multifamily space is incredibly strong. The fundamentals are incredibly strong. Rental growth is still very, very strong. Demand is still very strong. The high cost of buying a home only makes your tenants stay in longer. It's so much more economical to rent right now than it is to buy. So the fall off in the single family home buying market is a boom to the multifamily investor. So if they can find a way to refi out of their high octane bridge loan into an agency loan and buy themselves time, they're going to be okay. So there's no huge distress coming. There's no massive fire sales coming. It's kind of an equilibrium has to be found. So that's very important for your listeners to know, that the multifamily space is not a boom and bust space. It's very stable and a very strong and secure asset class.
right. But as you were relaying there, the debt cover
Yeah.
service, or the debt service cover ratio, uh, is that not really what's going to drive a lot of what the options are based on?
Yeah, for sure. But there's a lot of solutions as well. So there's a lot of ways to create a cap stack. So let's just use round numbers. Let's say you bought $100 million building in 2019, 2020. Let's say you put on a floating rate bridge loan at 80%. So you got an $80 million loan. 3 years later, you want to get out of this loan. You come to an agency lender like me. I'll size the deal based on the DSCR, and let's say my agency loan is only sizing to, let's say, $65 million. So now you've got a gap from the 65 to the $80 million. There are pref lenders out there that will give you the gap financing. So you can layer on top of your senior, you can layer a pref piece, and that pref piece will be able to take out your senior loan. So there are solutions rather than just being forced to sell. As long as you've done a good job running the asset, your collections are good, you've pushed your NOI over the last 3-4 years, you should be able to refi using a combination of senior agency debt and pref equity on top. And there's a lot of pref lenders. There's a drove of pref lenders that are sitting on a lot of dry powder.
Right. Are you seeing that that's typically the case, that if somebody has come in and they've been able to get their NOI up, that the numbers are still working, or is it?
Yeah, yeah.
Okay.
So many times by themselves, just on a senior, you're not there. But when you combine the senior and the pref, you're pretty much getting there 9 times out of 10.
Got it. Got it.
And the pref component is an accrued payment, so you're not stressing the asset. So the pref lender, your senior loan will have what their interest rate, what you have to pay monthly. The pref lender, many times, will accrue their amount to either sell or refi. So you're not stressing the property with a 12-13% pref piece. They'll have a hard pay component of 4-5%, and the rest will accrue.
And on that, is that almost like an equity position that they take, or is it just strictly a debt for the pref lender?
So it's for the pref lender is strictly debt, because an equity position is like a marriage. The minute you bring in an equity partner, you're married to that equity partner for life. No matter what, you refi 3 times, you sell at a crazy multiple, you're a partner. The pref equity is not really a partner. The minute they're paid, they're gone. So they're a little bit, so they are really debt. And in terms of how you treat it, it's treated as debt as well for taxes.
Got it. But it helps bridge the gap between what the agency will do now versus the
Correct.
full amount you need.
Correct.
And is that a typical percentage you're seeing as far as what the maximum loan to value the agencies will do right now? Is it 60? Is that what you're seeing?
No, that's not how the agencies work. The agency work to a DSCR covenant. So as long as you can hit the DSCR, so it's very simple. The higher the cap rate, the higher the loan is from the agencies. So in places where you're buying 6 caps, you can get up to 80% LTV from the agencies, or 75% LTV from the agencies. The tighter the cap rate, the lower the agencies are going to go. So they're just based on NOI. They're going to underwrite your in-place NOI, adjust it to the new taxes on acquisition. So as long as your NOI is good, you can get quite good octane leverage from the agencies.
And what is the debt cover, or the debt service cover ratio that the agencies write to? Is it 1.25, or?
It's to be a 125, 30-year AM, or it can, in some cases it can be a 130. So it depends. It depends on how the agencies view the deal. It depends on how you talk to the agencies to view the deal. But it's going to range from 125 DSCR to 130 DSCR. And on lease up deals, obviously they underwrite to a lower DSCR, and then you have a Freddie Mac value add program that underwrites to a 1.0 DSCR. So there's different programs with different DSCRs. But just for the sake of the listeners, to keep it simple, 125 DSCR is typically what they're looking for.
And as far as the amortization schedule, is it usually a 30-year AM? Is that what you're seeing with the
30-year AM, and in some cases you can push to 35-year AM with certain exceptions to get you more proceeds.
Okay, so there does sound to be like there's a way to make the equation work for somebody that's been operating a property well and is full and has pushed the NOI up. It's not necessarily there's going to be just all blood in the streets.
No.
But with respects to the opposite side of that coin, somebody who bought something, didn't buy the rate caps, had a plan of get in, get out kind of thing, and all of a sudden now they're stuck. What are you seeing there with something with those types of opportunity, or those?
So again, it's very hard to mess it up so badly, because we've had great rent growth, we've had great demand. Occupancy is at a very high point. There's much. We need a lot more units to come online than are coming online. Less people are moving out to buy homes. So if you've botched it up, you've done a pretty bad job, because there should be no reason why you've botched something. You haven't been able to drive NOI and drive occupancy. But if you have, then yeah, obviously you're going to have some pain, right? The vultures are going to be circulating, but you haven't done your job. You haven't looked after your property. I always say this to my clients. I said, at the core of the business, it's not just heads in beds. You're providing a service. You have to look after your tenants. You have to make sure that you're a good landlord, a good custodian, a good steward of the property. If something is broken, you have to fix it. If you have 1 million bad Yelp reviews, no one's going to want to live in your buildings, and that only comes down to you.
Yeah. So looking ahead here for the next couple of years, is there any kind of an expectation on the volume of loans that are due to expire or that are going to need to be replaced here
Yeah,
in
it's
23 versus 24? I mean, does it ramp up? Because I know
it's
there was kind of a little bit of a cycle, in the years prior where it seemed like it really ramped up, especially during COVID there.
yeah. So we've got time with those deals because last year was just insanity with the explosive growth in multifamily. Everybody and their uncle jumped on the bandwagon and bought multi. So there's a little bit of runway. There's a huge number of deals coming that will need to be refi. There's always going to have that, but a lot of those deals will work and a few won't. But on the majority, I would think a lot of those deals will find a home either with the agencies, regional banks, pref lenders, unique structures, maybe bringing in some fresh equity and diluting the previous equity. But there's no fall off a cliff disaster waiting for us here. It's not all rosy, but it's not all draconian either.
Right, right. No, it just sounds like there's a little bit of a struggle ahead to kind of. Is it more of just the change from where we've been to where we are? Is the issue, and that's really the struggle, or is it bigger than that?
I think it's two factors. I think one, people who bought very, very tight cap rates. The market in the Carolinas, the market in Texas, the market in Florida, deals were trading at 3.5 caps, right? Those
Right.
days are gone. Those days are over. Deals can no longer trade at those cap rates again because interest rates went from being at 10 basis points or SOFR and it's not LIBOR, but so low today to where they are. The 7-year today is much higher than it was a year ago. So it's the combination of rapid increases in interest rates, buying very tight cap rates, and trying to find an equilibrium now, because the cap rates market has blown out today. The same deal that you bought at a 3 cap is going to trade close to a 5 cap today, and it has to
Right.
trade close to a 5 cap because your debt is over 5.
Right, right, right. No, and I think that's really kind of if you're trying to make a deal pencil and you're using some old debt rate expectations as opposed to the new debt, it's a world of difference.
Yeah, and it's so fast. It's so fast, Darren. So
Yeah,
obviously right now the Republicans and Democrats can't agree on the debt ceiling. So if someone puts a deal under contract, let's say a week ago, the 10-year, let's say, is at 340, the 10-year today is at 367 or 370. The swings within a few days are so extreme that your deal goes from making sense to not making sense. So it's just a tough environment to get deals done because of the crazy swing in treasuries.
right. Let me ask you this: your firm and just kind of the outlook for the future here, based on this cycle we've been through, where the rates were just like historically low. I
Yeah.
mean, near zero for the longest time, as opposed to now and a historical marketplace. Is there any reason to believe, based on the demand and how strong the market is and kind of what you've been talking, that we should expect rates to go back to where they were or lower, or is this kind of like the new norm? What are you guys forecasting?
I don't think the rates are going to go back to where they were. I think the Fed are trying to deal with a particular problem, which is inflation. I think once they have inflation under control, they will bring rates in, but I don't think they're going to do 7 rate hikes, right? They've done 7 continuous rate hikes. They're not going to do 7 continuous cuts. So I think we're going to kind of settle on an equilibrium. We thought we had an equilibrium. The Fed spoke last time, said there'll be a pause and kind of everything hovered at the 350. And we thought, okay, so the 10-year will be around 350. We can understand that. If the spread on top of the 10 years 350 is, I don't know, 150, this is our level. But now again, that's been thrown out with the bathwater because now we have the debt ceiling issue. And if the US default on their debt, God forbid, that's going to cause a tremendous spike. So there's just so much uncertainty that it's very volatile. But again, hopefully they'll come to an agreement. Hopefully inflation will be dealt with. And then I think if inflation comes down, then I think towards the end of the year, maybe you'll see a little rate hike, maybe some light in the end of the tunnel. But I think it's going to be a long time since we see the numbers that we saw during COVID, where interest rates it was so cheap to borrow.
Right, right. No, I think those days are
something
for the history books. We'll always be able to look back to that and say, wow,
fondly.
yeah,
Fondly,
right,
that was great. That was wonderful. Yeah.
Right. So as far as the what's affecting lending right now, we've talked a little about the Fed policy, and they're trying to tame inflation. There was a time when like supply chain was an issue. Is that still driving any of the cost or any of the issues that some of your your new construction clients are facing?
I think you've got a perfect storm when it comes to new construction. One, you've got tremendous labor shortages. Our labor market is incredibly strong. Our unemployment is incredibly low, and the demand for skilled workers is incredibly high. We just don't have enough skilled workers to do the work. Two, cost of goods are sky high because of inflation, and then three, cost of variable floating rate construction debt is sky high as well. And you're talking 7-8%. So it's just everything together is making a lot of developers pause. So even Miami, which is an on fire market, related one of the largest companies in the world, was shovel ready on a project. They're taking a pause on their projects. You're seeing a lot of guys just say, it's entitled, it's ready. Let's put this in the back pocket. Let's put it in the drawer. And in a year's time, we'll revisit when the debt markets are, we're not borrowing at 7-8%, where our cost of goods are so high, inflation is rampant, and we can't get the labor because the labor costs are so high, wages are so high. It's just a perfect storm right now with everything, and that's always how it happens. 2008 was the same perfect storm. It never comes in ones. It comes in twos and threes and fours. That's what causes the pain and the suffering.
Right, right. No, it's trying to forecast demand and to catch the demand wave and win on that when there's demand, and then you have all these additional expenses that have their own demand, and
But the demand's there. I'll give you a staggering statistic that the National Multifamily Housing Council put out, that the US needs 3.7 million new apartments to be built this year, and all that's coming online is 640,000. And again, you have to just think of the bottlenecks. You got kids leaving college, becoming first-time renters. You typically had renters becoming first-time buyers. Those renters now stay as renters. So you've got new immigrants, new people coming in all the time. So you've got this bottleneck of people who need housing that we're not going to be able to give them housing. So of course, rents are going to continue to rise. So there's some difficulty on the housing side, on that side, because of demand.
Yeah, I was curious, does immigration play a large part of that demand, or is that just one of the factors in the demand?
No, besides what you see on the news, there's still a ton of people coming into the US all the time on visas, on immigration, on work visas, right? So besides what you have on the border, you also have legitimate people coming in all the time to work here. So there is a huge influx of people coming. There's a huge influx of college kids finishing college and becoming first-time renters. So there is just a ginormous demand, and just the numbers are just polar opposite from needing close to $4 million homes to delivering close to 700,000 homes. We can't keep up. Which again, it's good for the multifamily owners because that's what makes their assets so desirable.
Right. No, there's definitely an exit opportunity in the future. There's somebody going to want to buy what you have, and there's demand to rent what you have. So that's definitely a good thing.
Even with one more thing, in New York City, which is, I think, always the best barometer to what happens in the rest of the country, New York City has the highest rent growth. It's 6.1% since 2005. So,
wow, that's strong.
Yeah,
that's strong. Hey, on some of the other factors that have been affecting the market, are any of these bank failures, are they affecting the lenders? Yeah,
sure. So Signature Bank was a huge player in New York real estate. The agencies are not such a huge player in the New York real estate market because they can't get their head around the price per unit, right? Their typical highest price per unit is going to be $350,000 a unit on value. New York, that is so much higher. You know, the units can have a value of close to $1 million a single unit. So the agencies were never really a player in New York City because they couldn't wrap their heads around values. So the regional banks here were such huge players. So Signature, no longer in business, was a huge player. So they're gone. Santander is a very big player. They've pulled back. So there's been a huge pullback from the regional banks. They're just very, very nervous, taking a long time to get quotes out of them, very hard to pull quotes out of them. They're just very, very nervous right now. So yeah, the regional banks again have put all the onus on Freddie Mac and Fannie Mae, making them really the kings in the multifamily space.
Yeah. With the change in the marketplace, are you seeing that your investors are having any difficulty raising capital
Yeah.
for the down payment?
Yeah, of course. So a year ago, you could have a deal, throw it out there on an email chain to a bunch of guys, and you have 20 guys handing you money to do the deal. The syndicators were kings. Today, the syndicators kind of are sitting in the darkness in a corner, huddled up, because it's very hard to raise equity. The equity markets are very frozen. The Far East, the Koreans were big players. The Japanese were big players. Those guys are kind of sitting on the sidelines because they did some very bad deals on office and hotel and condo that they shouldn't have done. So those guys are off. And then the big institutional equity guys are really picking their spots. They really want to find where they can really hit higher returns. So they're being very, very selective. So yeah, the syndicators are not active right now. Again, that explains why you've got a 75% drop in transactions. So a lot of those guys have been sidelines. I would say the main players that are still very, very active today are the big institutional funds that buy on behalf of their clients, because they're sitting on a lot of dry powder. They've struggled in recent years to buy because they've been priced out because of over aggressive syndicators. They now have the pick of the litter, and they can go out and pick up some really, really good deals. And we're seeing that our clients are picking up some really excellent deals and not having to fight like they had to fight a year ago to win a deal.
Yeah, I was kind of curious with the volume of deals that were syndicator driven in 22. Do you have any sense of the percentage of the market that was syndicator driven?
Yeah, I would say it was 30-40% of the market was syndicated driven deals, and those guys are gone. Very, very few syndicated deals are getting done, especially because a lot of the guys are not giving returns on previous deals they did, because again, they had floating rate bridge debt. Now they bought it when SOFR was at 10 bips, 10. Now SOFR is at 5, right? So all they're doing is using all the cash flow to keep current on the debt. So they're not really giving returns to their equity. So how can you go back to that equity investor and say, hey, pony up another million, 2 million for me to buy another deal? But they said, well, look at the deal we bought last year. I'm getting no returns on that.
Right. No, it is. It's interesting how the how volatile the market can be, and actually just how quickly the market changed with the Fed changing the interest rates.
And a lot of people blame the Fed for reacting way too slowly. They should have started raising interest rates way before they did. They didn't. They waited. They held, and that's caused them to keep on aggressively raising over and over again, which has really spooked the market. I would say the Fed have been rather cavalier and caused a lot of these issues by not reacting faster.
So let me ask you, the LIBOR to the SOFR changed. Do you see that having any effect on this?
No, I don't think it made the difference what we changed to the 30-day SOFR to LIBOR. That's not what made the difference. What makes the difference is having SOFR go from 10 bips to close to 5. That's a massive delta. That's a crazy delta. So think about it. Think about a guy that bought a deal. SOFR was 10 bips. He had a 300 spread over. He was paying 310. That was his interest rate. Now he's 300 over 5, right? So he's 8%. He's paying 8% of interest, right? So it's gone from 350 or 310 to 8. That's a huge delta.
Yeah, no, you're gonna struggle with those numbers. I don't care how able
how good you are.
You were able to push your rents. I mean, that's the numbers don't work. At least the same deal doesn't work on the same principle, same starting point. That's tough. So what about you talked about the demand, and you mentioned the number, I think it was 3.7 million units is what the multifamily housing projection demand is. As far as markets that you're seeing that are still red hot, are these the primary markets, or with pre-COVID, it seemed like urban core was like the the darling. And then when COVID hit, it seemed like kind of,
Sunbelt.
yeah, a lot, there's a lot of movement away from some of the downtowns to, where you lifestyle kind of Sunbelt stuff. Is Sunbelt still kind of the driver right now?
So this is how I would answer this. There's the only red hot market left today is South Florida, because the demand for South Florida is just so big. So that is just a hot market. Miami is on fire. And because Miami can't house all these people, it's moved everything over. So you've got Homestead, Boca, Delray. Those markets are just doing so great. Fort Lauderdale, Tampa. So Florida is red hot, but Florida has its own headwinds, which is insurance. I would say COVID caused the biggest winners of COVID were Texas, Carolinas, and Florida. The biggest losers were New York and California. I think in a way, New York has come back very, very strong. The demand in New York is sky high. You put a deal on, you put an apartment on Airbnb, you have 150 people outside going to see that little unit. The cost of a single one bedroom is, I believe, over $5,000. So New York has just gone through the roof. California, less so. But in my opinion, I think the best market, one of the markets that I love the most and is often overlooked, is the Midwest. I think places like Columbus that have a huge university population, Intel building their $3.1 billion facility, great, right in the middle, great central location. Columbus is a fantastic market. And the reason why it's a fantastic market is because the cap rates are where they need to be to get deals done. Florida, because of the demand, the cap rates are still so low. It's tough, put that with insurance, tough to get deals done. Really have to pick your spots. We're seeing a lot of transactional volume happening in the Midwest, Columbus, Kentucky. Those are the places we're seeing a lot of deals happening, because you're buying 6.5 caps, 6 caps. And if you're buying a 6 cap, you can get 80% agency financing, very tight spreads. So 130, 140 with buy downs. So we're seeing a lot of activity in, I would say, between the Midwest, number 1, followed by Texas and Florida, 2 and 3. But then you've seen a huge drop off everywhere else, because the Carolinas was red hot for a while, but sellers don't want to capitulate. So you're not seeing a lot of trades. So those markets are kind of just suffering, not badly, just not seeing a lot of deals getting done, because the cap rates haven't come to where deals need to be to make sense. While in Florida, the rental growth is still so strong that you can buy a 4.5 cap and bet that the rental growth is going to push you to a 5.25 cap.
So on the Midwest cap rates, what was the low that the cap rates got to the markets that you're talking about?
So again, that's another thing. The cap rates never got that crazy low in those markets. They never got to where the Texas markets got to 3s. Austin, you had deals in Austin trading at the low 3 cap rates. Austin was so on fire. So that's going to be a time till the sellers understand where the new paradigm is. But the Midwest never really got that tight. It never got down. It was always 4.5. It never got down into the 3s. So to push that cap rate from a 4.5 to a 5.5 is not such a huge jump and not such a hot, bitter pill to swallow. So that's where the volume is being done. That's where the activity is being done. And then I think we've got to talk about Phoenix. Phoenix is just also having its moment in the sun. A lot of people coming out of California going to Phoenix. So Phoenix is also having its moment. Also, the cap rates are getting pretty good in Phoenix as well. So there are certain light spots where deals can get done, where it makes sense to do deals. And again, that's going to be number 1, the Midwest for me, where cap rates are where they need to be. It's always slow and steady wins the race. The Midwest has never boom and bust. It's not going up like Tampa, 19% rental growth. It's always ticking along 3-4% rental growth. That's a super strong market. A lot of transactions happening there. Florida, a lot of transactions happening there because, again, rental growth is so incredibly strong in certain markets. And then Texas, to a lesser degree, again, because the rental growth is so good. And again, the cap rates have kind of moved to where they need to move.
Yeah. No, the Midwest isn't sexy, but it seems like it's pretty steady. So
steady wins. I always say steady wins the race. And I don't know if it's not sexy. It doesn't have the weather and the pizzazz and the flair that some of these other places do. but it's just a very solid market. I've been doing deals in the Columbus market with a colleague of mine called George Scaff, who has a staggering number there. He has 96% market share in Columbus as a broker. So we've been doing deals there, which is crazy. He really dominates that market. So we've been doing deals there for the last 7 years, and everybody that's bought there has bought well, been able to sell well, bought again, been able to sell well. Growth has been good, collections have been good. It's just a great market.
Well, the cost of living in the Midwest is, it's doable, and it gives people there's a little bit of extra money left over to where they can do things, as opposed to what'd you say, 1 bedroom in New York's going for $5,000 a month right now? Wow.
And also the university is a big driver, because a lot of the kids that go to the universities there want to end up staying there.
Yeah. Nope. Good to have demand. That's good. Hey, Henry, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we could avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. Could be your clients, investors, the Fed, political, interest rates, however you would like to frame the question and identify what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Henry Stimler, what is the biggest risk?
I think the biggest risk is not doing. I think more is lost by inactivity than activity. The biggest killer of deals is time and dalliance and not getting it done. So I'm a very big believer in that you have to jump in, right? You have to be all the way in. You can't be partially pregnant, and you have to have conviction in your decisions. And if you don't have conviction, that's the biggest risk. If you are waffly, if you don't know if you want to buy it, if you don't know how you're going to run it, that's the biggest risk to me. So when I see clients who are unsure, who are not confident in their decision, I see that as a red flag. I think you've got to make moves, move quickly. That's the best way to mitigate risk. If you see a deal that you like that makes sense, you got to move quickly. 1, to wrap it up. 2, to get the right debt in place, rate lock your debt, take that risk off the table and move quickly. So that's what I see as the biggest risk is not having conviction in your decisions and not having the gumption to go forward and get it done.
No, that's awesome. The inaction, there's a lot of time just spent, grinding your teeth and working the pencil and all that, but eventually you have to kind of fish or cut bait, as they say. So.
Yeah, you got to start by making sure the numbers work. Numbers never lie. My dad always says that. Do the numbers, do the math, make sure it makes sense. But once you know it makes sense, then just go. And time is the biggest problem. As I mentioned earlier, you could be at a place where the treasury is 350, and in 5 days' time, the treasury is at 367. And because you've kind of wasted time and waffled around, you've lost 17 basis points, and that's materially hurt your return. So if you've made a decision, you want to go for it, go for it. Be quick.
Right. No, and the flip side could be true too. You find a 3.7 and then the rate goes down to 3.6, and you because you locked in, you're ahead. So it's good stuff. Hey, Henry, where can the listeners go if they would like to learn more or connect with you?
Sure. So I'm on LinkedIn, Henry Stimler, Stimler. I'm on Instagram, Henry Stimler again. So you can find me on those 2 social media platforms, and I'm always happy to respond and connect.
All right. Well, Henry Stimler, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you very much, Darren. Enjoy.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.